When people respond rationally to incentives, that is not a consumer protection problem.
Hi, I'm Nick Gillespie for Reason TV. Today we're talking with Todd Zawicki, a law school professor at George Mason University and a senior scholar at the Mercatus Center. Thanks for joining us, Todd.
Glad to be here, Nick.
Let's talk about the Consumer Financial Protection Agency, which is going to be created by legislation being introduced shortly. Its goal is to protect consumers from out-of-control debt that they might find themselves in, or from nefarious banks and other lenders who are screwing them over. Elizabeth Warren, or supposedly screwing them over, Elizabeth Warren, who would be the person who is backing this plan, a Harvard Law School professor who's also the head of the Congressional Oversight Commission related to TARP, tells us that the credit market is broken and that consumers can't compare financial products because they are too complex. Is she right or is she wrong?
That's the premise of this new agency, and the agency is one of the centerpieces of the Obama financial regulatory reform package, along with things like a systemic risk regulator, that sort of thing. There's sort of a dual premise that's embedded in it, which is the idea first that somehow the CFPA would improve the operation of markets by improving competition, making competition work better. At the same time, there's a huge number of regulations there that seem to sort of follow old-style kind of 1970s regulation, where they would simply replace what market competition would produce. Whatever it is, it goes far beyond how we've thought about consumer credit regulation over the past 20 or 30 years in this country.
Here, is there a problem with consumer credit? Are people not able to pay their credit card debts? And if they can't, is it because they don't understand what they're supposed to be paying?
When you look at the data, one thing is very, very clear, that even though people are very concerned about the growth of credit card debt over time, what we see is that the growth of credit card debt has come about as a replacement or substitution of other types of debt that people used to use. So
people aren't piling on more debt. They're putting stuff on credit cards that in the past they might have put on a home equity line or some other.
Or even more than that, if you think about, say, 30 years ago, if you wanted to buy a refrigerator or a bedroom set, what would you do? You'd go down to the local appliance store or furniture store, you'd open a line of credit, you'd pay it off $125 a month for 36 months until it was paid off.
And probably pay 30% interest.
30 or 40% interest, and you might, and to some extent, what we know is that those prices were also embedded in the price of the goods.
Is there competition among credit card offers?
I think that anybody who opens their mailbox knows that there's plenty of competition among credit card issuers for their business.
And so if somebody like Elizabeth Warren or the Obama administration says we can make this more competitive and less regulated, I mean, it just seems silly on the face of it.
It's hard to imagine that that market could possibly be more competitive than it is already. There are about 6,000 issuers of credit cards in the country right now.
Let's talk about mortgages, because part of the CFPA would also, I mean, it's about simplifying products, and Warren and other people actually say what we need are plain vanilla products that everybody can understand. And is the problem in the housing market or in the mortgage market, is it complex instruments that the very people who are taking these loans out can't understand?
Mortgages are obviously very complicated products, and a lot of people, regardless whether they're prime or subprime borrowers, struggle with understanding every single detail that is in their mortgage. One of the reasons why you get that great big thick pile of documents whenever you buy a home is because so many of those are either regulated or mandated by regulation, or have been added in basically because of fear of lawsuits and that sort of thing. With respect to the more general point, though, if you think about the financial crisis, it's clear that the financial crisis was not caused by problems of consumer understanding or defrauding consumers. Certainly there were lenders who defrauded consumers, and certainly there were consumers who defrauded lenders, and certainly there were lenders and consumers who seemed to be defrauding each other.
But they were following larger incentives, right?
Exactly. The bottom line, what caused the financial crisis more than anything else, was not a failure to understand what was going on, but that people understood too well what was going on. That the problem that caused the financial crisis was misaligned incentives. Incentives that created by Federal Reserve monetary policy, by various state laws and that sort of thing, that provided incentives to overinvest in housing, and now, as we're seeing, provide incentives for people to walk away from their houses when they're not worth what they used to be.
So in other words, I mean, it wasn't that somebody gets into a house and then realizes, oh my God, there is no way I can pay my mortgage. Rather, it was that people were flooding into the mortgage market because they knew the government was backing the increasing values of their houses, and they were able to take more risks.
Exactly. Sure.
Including the banks also saying we're going to go out to riskier borrowers because we're going to get backed up.
Certainly, there were some people who got confused by their mortgages, but everything indicates that was a small minority. What really spurred this was people responding to the ability to get cheap money, and now responding to the incentives that they have to be able to walk away from their houses. When people respond rationally to incentives, that is not a consumer protection problem.
Is there anything in the Consumer Financial Protection Agency plans that would fundamentally change those incentives?
There's nothing that would change those incentives. In fact, the whole premise of the agency seems to be based on the idea that consumers are sort of hapless victims who can't shop for credit products and are just, overwhelmed by the world. And there's almost a staunch denial that consumers respond to incentives or that lenders respond to incentives.
There's at least one sense in which the credit markets are broken, is that nobody is quite clear what's going to happen next in terms of regulatory regimes and whatnot. And if there's a lot of risk, everybody kind of sits out waiting to see how the dust will settle. What should the Obama administration be doing if it wants to kind of pour oil on the troubled waters of consumer credit markets?
Well, they should not do this. What this is going to do is exacerbate the uncertainty we already see, and it's going to also have the inherent problems of any bureaucracy, which is it's going to create one-size-fits-all rules that aren't going to work. A good example is that 77% of small businesses use credit cards in their operations. Yet, under the definitions of the CFPA, all those small business people out there are going to be considered consumers, and they're going to be considered to be the same sort of people who can't shop in any sophisticated way for the credit cards that are good for their business. And so what you're going to have is not just a negative impact on consumer choice and innovation. You could have negative impacts on small business development and that sort of thing.
What would be a better regulatory regime?
Well, there's a number of things they could do without creating this whole huge new bureaucracy. Number one, certainly disclosures could be improved. The Federal Trade Commission about 2 years ago did an excellent study where they interviewed prime and subprime borrowers, and they came up with a whole list of ways in which disclosures could be improved so that people could shop in a better way. Secondly, you don't need to create a new bureaucracy for this particular product. The Federal Trade Commission, for instance, already knows how to regulate consumer credit. Third, I think the Republican proposal on this is actually worth looking at, which is the Republican proposal would combine the new elements of the CFPA with the ability of an agency to be able to regulate safety and soundness issues. What the Obama program does is takes the Consumer Protection Mission away from the Federal Reserve and puts it in this one new agency, but doesn't think about what impact that might have on safety and soundness of financial institutions.
Final question, what's in your wallet? How many credit cards are you packing right now?
I carry 4 credit cards in my wallet, and I think that's one of the great innovations, is we've gotten rid of annual fees. Credit card issuers compete for my business literally every time I open my wallet. They are competing for my business. And the ability of consumers to hold multiple credit cards and to choose the one that's best for them, even on a day-to-day basis, is a remarkable benefit to consumers, and it'd be a real shame if that went away because of overzealous regulation.
I want to thank Todd Zawicki of George Mason University Law School and the Mercatus Center for talking to us today. For Reason TV, I'm Nick Gillespie.